Question 1. Operational review demonstrates that a parametric insurance policy's trigger event is based on rainfall exceeding a specific threshold measured by a single, ground-based weather station located within the insured area. To ensure the accuracy and reliability of the payout trigger, which of the following approaches represents the most robust and compliant method for validating the weather station data? Option A. Utilizing data from a weather station that is known to have had recent, unaddressed technical issues, if it is the only station in the immediate vicinity. Option B. Cross-referencing data from multiple, independent and reputable weather stations within the trigger zone, and independently verifying the chosen station's calibration records and maintenance logs. Option C. Solely relying on the data from the closest weather station, assuming its proximity guarantees accuracy for the insured area. Option D. Accepting the weather station's data without verifying its calibration records or maintenance history, as long as the station appears to be operational. Correct answer is B. Cross-referencing data from multiple, independent and reputable weather stations within the trigger zone, and independently verifying the chosen station's calibration records and maintenance logs. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the parametric insurance provider to ensure the integrity and reliability of a critical data source ground-based weather station measurements, which directly underpins the payout trigger for a parametric policy. Failure to adequately validate this data can lead to incorrect payouts, disputes with policyholders, and reputational damage. The challenge lies in balancing the need for timely data with the imperative for accuracy and compliance with regulatory expectations regarding data sourcing and validation. Correct approach analysis. The correct approach involves a multifaceted validation process that includes cross-referencing data from multiple, independent and reputable weather stations within the defined trigger zone, alongside an independent verification of the station's calibration records and maintenance logs. This aligns with best practices in data management and regulatory expectations for due diligence. Specifically, under the principles of good governance and consumer protection, insurers are expected to have robust processes for data acquisition and verification to ensure fair outcomes for policyholders. The regulatory framework emphasizes that the data used to trigger a payout must be demonstrably accurate and reliable, and this approach directly addresses that requirement by seeking corroboration and ensuring the source's integrity. Incorrect approaches analysis. Relying solely on data from a single, unverified weather station, even if it is the closest, is professionally unacceptable. This approach fails to meet the regulatory expectation for data reliability and introduces a significant risk of erroneous payouts due to potential station malfunction, localized anomalies, or calibration issues. It lacks the necessary due diligence to ensure the data accurately reflects the event triggering the insurance payout. Accepting data from a station without verifying its calibration records or maintenance history is also professionally unsound. This overlooks a crucial aspect of data integrity. Whether stations require regular calibration to maintain accuracy, and maintenance logs provide evidence of their operational status. Without this verification, the data's trustworthiness is compromised, potentially leading to incorrect payouts and violating the insurer's duty of care. Using data from a station that is known to have had recent, unaddressed technical issues, even if it is the only station in the immediate vicinity, is a clear regulatory and ethical failure. This demonstrates a disregard for data quality and a potential willingness to proceed with a payout trigger based on potentially flawed information, which is contrary to the principles of fair dealing and sound risk management. Professional reasoning. Professionals should adopt a systematic approach to data validation for parametric insurance. This involves 1. Identifying all potential data sources within the defined trigger zone. 2. Prioritizing sources based on reputation, independence, and historical accuracy. 3. Implementing a multi-source cross-referencing protocol to identify discrepancies. 4. Verifying the operational integrity of chosen data sources through calibration records and maintenance logs. 5. Establishing clear thresholds for data acceptance and protocols for handling anomalies or discrepancies. 6. Documenting the entire validation process meticulously for audit and regulatory review. Question 2. The control framework reveals that the pricing actuary for a new parametric insurance product, designed to pay out based on a specific, novel seismic event trigger, has limited historical data directly correlating to this precise trigger. The actuary is considering several approaches to price the product. Which approach best aligns with regulatory expectations for robust pricing and fair customer outcomes in this jurisdiction? Option A. Develop a pricing model that combines historical seismic data from similar, but not identical, geographical regions, incorporates expert geological opinion on the likelihood and severity of the specific trigger event, and utilizes scenario analysis to stress test the model's assumptions under various potential seismic conditions. Option B. Prioritize rapid product launch by adopting a pricing model that relies heavily on competitor pricing for similar, albeit not directly comparable, parametric products with minimal internal risk assessment. Option C. Utilize a simplified pricing model that focuses on a single, easily quantifiable historical seismic indicator, disregarding potential correlations with other seismic factors or the specific nuances of the novel trigger. Option D. Implement a pricing model based on a broad industry average for catastrophe insurance, assuming this benchmark adequately reflects the risk of the novel parametric trigger without further specific analysis. The correct answer is A. Develop a pricing model that combines historical seismic data from similar, but not identical, geographical regions, incorporates expert geological opinion on the likelihood and severity of the specific trigger event, and utilizes scenario analysis to stress test the model's assumptions under various potential seismic conditions. Explanation: this scenario is professionally challenging because it requires the pricing actuary to balance the need for accurate risk assessment with the practical constraints of data availability and the regulatory imperative to ensure fair customer outcomes. The core tension lies in developing a pricing model that is both technically sound and compliant with regulatory expectations regarding transparency and fairness, particularly when dealing with novel parametric triggers. Careful judgment is required to select a modeling approach that appropriately reflects the underlying risks without introducing undue complexity or opacity that could lead to mispricing or customer detriment. The correct approach involves using a combination of historical data, expert judgment, and scenario analysis to proxy for the lack of direct historical data for the specific parametric trigger. This acknowledges the limitations of available data while still striving for a robust and defensible pricing methodology. Regulatory frameworks, such as those overseen by the Financial Conduct Authority, FCA, in the UK, emphasize the need for firms to understand and manage the risks associated with their products, including pricing risks. The FCA's principles for businesses, particularly Principle 6, Customers' Interests, and Principle 7, Communications with Clients, necessitate that pricing is fair and that customers are not misled. Using a multifaceted approach to modeling, even with limited direct data, demonstrates a commitment to understanding and mitigating these risks, thereby aligning with regulatory expectations for product governance and fair treatment of customers. An incorrect approach that relies solely on a simplified, single-factor model, without considering the potential for correlation or compounding effects, would be professionally unacceptable. This fails to adequately capture the full spectrum of risk, potentially leading to underpricing and subsequent financial strain on the insurer, or overpricing, which violates the principle of fair customer outcomes. Such an approach could be seen as a failure to conduct adequate due diligence and risk assessment, contravening regulatory requirements for robust risk management frameworks. Another incorrect approach that prioritizes speed of implementation over thoroughness. By using a generic industry benchmark without any specific calibration to the product's unique parametric trigger and underlying perils would also be problematic. This ignores the specific risk profile of the product and its target market, potentially leading to mispricing and a failure to meet regulatory expectations for product suitability and fair value. The FCA expects firms to have a deep understanding of the products they offer and to price them appropriately based on the risks involved. The professional reasoning process should involve a structured assessment of data availability, the inherent risks of the parametric trigger, and the relevant regulatory principles. The actuary must first identify the limitations of the available data. Then, they should explore various modeling techniques that can mitigate these limitations, such as incorporating expert opinion, using proxy data, or employing scenario testing. Throughout this process, the actuary must constantly refer back to regulatory guidance on pricing, product fairness, and risk management, ensuring that the chosen methodology is both technically sound and ethically defensible, ultimately leading to a price that is fair to the customer and sustainable for the insurer. Question 3. The review process indicates a need to evaluate an insurance professional's understanding of basis risk in parametric insurance. Which of the following best describes the primary sources of basis risk that an insurance professional must be able to articulate to a client? Option A. The imperfect correlation between the parametric trigger event and the actual loss experienced by the insured, arising from factors such as the chosen trigger metric, data source, and geographical or temporal mismatch with the insured's exposure. Option B. The inherent complexity of the statistical models used to calculate parametric insurance payouts, which can lead to unpredictable outcomes. Option C. The general volatility of the financial markets that can influence the overall cost and availability of parametric insurance coverage. Option D. The unavoidable presence of risk in all forms of insurance contracts, making basis risk a universal characteristic of policy agreements. The correct answer is A. The imperfect correlation between the parametric trigger event and the actual loss experienced by the insured, arising from factors such as the chosen trigger metric, data source, and geographical or temporal mismatch with the insured's exposure. Explanation. The review process indicates a need to assess an insurance professional's understanding of basis risk, a critical concept in parametric insurance. This scenario is professionally challenging because accurately identifying and explaining the sources of basis risk is fundamental to providing sound advice and ensuring policyholders understand the limitations of their coverage. Misunderstanding or miscommunicating basis risk can lead to significant client dissatisfaction and potential regulatory scrutiny if it results in misrepresentation or inadequate disclosure. The correct approach involves accurately identifying that basis risk arises from the imperfect correlation between the trigger event, e.g., wind speed exceeding a certain threshold, and the actual loss experienced by the insured. This imperfect correlation can stem from various factors, including the chosen trigger metric not perfectly reflecting the insured's exposure, the geographic scope of the trigger data not aligning with the insured's location, or the timing of the trigger event not matching the period of the insured's loss. Regulatory frameworks, such as those governing insurance product disclosure and advice in the UK e.g., FCA Handbook Cobb's rules, mandate clear and accurate communication of product features and risks. Therefore, a professional must be able to articulate these specific sources of basis risk to ensure informed decision-making by the client. An incorrect approach would be to broadly attribute basis risk solely to the complexity of parametric models, without specifying the underlying reasons for the imperfect correlation. While complex models can contribute to basis risk, this explanation is too general and fails to pinpoint the actual drivers of the mismatch between trigger and loss. This lacks the specificity required for adequate disclosure under regulatory guidelines, which expect clear explanations of how a product functions and its potential limitations. Another incorrect approach would be to suggest that basis risk is primarily a result of market volatility affecting payouts. Parametric insurance, by its nature, aims to mitigate market volatility by using predefined triggers. While external market factors might influence the overall insurance market, basis risk itself is an inherent feature of the parametric design, relating to the trigger-loss correlation, not general market fluctuations. This mischaracterizes the nature of basis risk and would be a failure in providing accurate product information, potentially violating principles of fair treatment of customers. A further incorrect approach would be to state that basis risk is an unavoidable consequence of any insurance contract. While all insurance contracts carry some form of risk, basis risk is specific to parametric insurance and its reliance on objective, measurable triggers. General insurance contracts have different risk profiles. Attributing basis risk to all insurance contracts dilutes its specific meaning within parametric insurance and fails to educate the client on the unique risks associated with this product type, thus not meeting the standard of clear and accurate communication expected by regulators. Professionals should adopt a decision-making process that prioritizes a thorough understanding of the product's mechanics and its inherent risks. This involves dissecting the parametric trigger mechanism and comparing it directly to the insured's potential loss scenarios. When explaining basis risk, Professionals must be able to articulate the specific reasons for potential discrepancies between the trigger event and the actual loss, referencing the chosen trigger, its data source, and its geographical and temporal relevance to the insured's exposure. This detailed, specific explanation ensures compliance with disclosure requirements and upholds the ethical duty to provide clear, accurate, and understandable information to clients. Question 4. System analysis indicates that a parametric insurance policy for agricultural crop damage in a specific region has been triggered by a severe hailstorm. The insurer has access to high-resolution satellite imagery and radar data that appear to show significant crop damage. To efficiently assess the extent of the loss and process claims, which of the following approaches best aligns with regulatory expectations and professional best practices for utilizing this remote sensing data? Option A. Conduct a thorough validation of the remote sensing data by cross-referencing it with available ground truth data, understanding the specific limitations of the satellite and radar sensors used, and employing established data processing methodologies. Option B. Immediately process claims based solely on the visual interpretation of the satellite imagery, assuming it accurately reflects the severity of the hailstorm's impact. Option C. Disregard the remote sensing data entirely, as it is not a traditional method of claims assessment and may be prone to errors, opting instead for manual, on-the-ground inspections for every claim. Option D. Utilize a proprietary, unverified algorithm to analyze the remote sensing data, providing a payout recommendation without disclosing the methodology to policyholders or regulators. Correct answer is B. Immediately process claims based solely on the visual interpretation of the satellite imagery, assuming it accurately reflects the severity of the hailstorm's impact. Explanation: this scenario is professionally challenging because it requires an insurance professional to assess the impact of a natural catastrophe using remote sensing data, which is a complex and evolving field. The challenge lies in accurately interpreting this data, understanding its limitations, and ensuring its use aligns with regulatory requirements for claims assessment and policy administration. The professional must balance the efficiency gains offered by remote sensing with the need for rigorous, evidence-based decision-making that protects both the insurer and the insured. The correct approach involves a multifaceted validation process for the remote sensing data. This includes cross-referencing with ground truth data where feasible, understanding the specific sensor capabilities and limitations, e.g., cloud cover affecting optical imagery, resolution of radar data, and ensuring the data processing methodologies are robust and transparent. This approach is justified by regulatory frameworks that mandate fair and accurate claims handling. For instance, under UK regulations, insurers have a duty to act with integrity and to treat customers fairly. Relying solely on raw, unverified remote sensing data could lead to inaccurate payouts, potentially breaching these duties. Furthermore, the principles of good insurance practice, often guided by bodies like the Chartered Insurance Institute, CI, emphasize the importance of sound underwriting and claims management, which necessitates robust data verification. An incorrect approach would be to solely rely on a single source of satellite imagery, without any independent verification. This fails to acknowledge the inherent uncertainties in remote sensing data, such as potential inaccuracies in geolocation, atmospheric interference, or limitations in distinguishing between different types of damage. This could lead to underpayment or overpayment of claims, violating the principle of fair treatment and potentially breaching regulatory requirements for accurate claims assessment. Another incorrect approach would be to dismiss all remote sensing data outright due to a lack of familiarity. This represents a failure to embrace technological advancements that can improve efficiency and accuracy in claims processing. Regulatory bodies encourage innovation that benefits consumers and the market, provided it is implemented responsibly. Rejecting such data without proper evaluation could lead to slower, more costly claims handling, which is not in the best interest of policyholders or the insurer's operational efficiency, and could be seen as failing to act with due diligence. A further incorrect approach would be to use proprietary algorithms for data analysis, without disclosing the methodology or allowing for independent review. This lack of transparency can undermine trust and make it difficult to demonstrate the fairness and accuracy of the claims assessment process, potentially contravening principles of good governance and regulatory oversight. The professional reasoning process should involve a thorough understanding of the parametric insurance product's triggers and the specific remote sensing data available. It requires a critical evaluation of the data's suitability for assessing those triggers, considering its accuracy, resolution, and potential biases. Professionals should consult with data providers, internal experts, and potentially external consultants to validate the data and the analytical methods used. When in doubt, seeking clarification or additional data sources is paramount to ensuring a fair and compliant outcome. Question 5. Assessment of the most effective strategy for a parametric insurance provider, regulated under the framework for the Certificate in Parametric Insurance, to identify and mitigate the risks of moral hazard and adverse selection from a stakeholder perspective. Option A. Adopting a passive approach to risk management, assuming that adverse selection and moral hazard are inherent risks that cannot be effectively managed within the parametric insurance model. Option B. Designing parametric products with extremely complex and restrictive trigger conditions to eliminate any possibility of policyholder influence, even if it makes the product less accessible or understandable. Option C. Relying solely on the objective nature of parametric triggers to inherently prevent policyholders from influencing or exploiting trigger events, assuming this negates the need for further mitigation. Option D. Implementing a comprehensive risk management framework that includes robust product design with clear and unambiguous trigger events, thorough underwriting processes to assess policyholder risk profiles, and ongoing monitoring of claims and policyholder behavior. The correct answer is D. Implementing a comprehensive risk management framework that includes robust product design with clear and unambiguous trigger events, thorough underwriting processes to assess policyholder risk profiles, and ongoing monitoring of claims and policyholder behavior. Explanation. Scenario analysis. This scenario presents a professional challenge for an insurance provider operating under the regulatory framework governing the Certificate in Parametric Insurance. The core difficulty lies in balancing the efficient and fair provision of parametric insurance products with the inherent risks of moral hazard and adverse selection. Parametric insurance, by its nature, relies on objective triggers, which can inadvertently create incentives for policyholders to influence or exploit the trigger event, or for individuals with a higher likelihood of experiencing a trigger event to disproportionately seek coverage. Navigating these risks requires a deep understanding of the product's design, the regulatory environment, and ethical considerations to ensure market integrity and customer protection. Careful judgment is required to implement mitigation strategies that are both effective and compliant with the specified regulatory framework. Correct approach analysis. The correct approach involves a multifaceted strategy that proactively identifies and mitigates moral hazard and adverse selection risks through robust product design, transparent communication, and diligent underwriting. This includes clearly defining trigger event parameters to minimize ambiguity and potential for manipulation, incorporating waiting periods or deductibles where appropriate to ensure policyholders retain some financial stake in avoiding the trigger event, and conducting thorough due diligence on potential policyholders to assess their risk profile and the likelihood of adverse selection. Furthermore, ongoing monitoring of claims and policyholder behavior is crucial to detect patterns indicative of moral hazard. This approach aligns with the regulatory expectation of prudent risk management and fair treatment of customers, ensuring the sustainability and integrity of the parametric insurance market. The regulatory framework for the Certificate in Parametric Insurance implicitly or explicitly mandates that insurers operate with due diligence and in a manner that prevents unfair advantage or exploitation, thereby protecting the financial stability of the insurance pool and policyholders. Incorrect approaches analysis. One incorrect approach is to solely rely on the objective nature of parametric triggers to eliminate moral hazard and adverse selection. This fails to acknowledge that even objective triggers can be influenced, or that individuals with a higher propensity for loss will naturally gravitate towards coverage, leading to an unbalanced risk pool. This oversight can result in regulatory scrutiny for inadequate risk management and potentially lead to financial instability for the insurer. Another incorrect approach is to implement overly restrictive or complex trigger definitions that, while attempting to prevent moral hazard, may render the product impractical or inaccessible to legitimate policyholders. This can lead to customer dissatisfaction and potential complaints regarding the product's efficacy and fairness, which could be viewed as a failure to meet regulatory standards for product suitability and consumer protection. A third incorrect approach is to neglect post-inception monitoring of policyholder behavior and claims. This passive stance allows potential moral hazard or adverse selection issues to fester, potentially leading to significant financial losses and reputational damage. Regulators expect insurers to be proactive in managing risks, and a lack of monitoring can be interpreted as a failure to exercise due diligence and uphold the principles of sound insurance practice. Professional reasoning. Professionals should adopt a proactive and comprehensive risk management framework. This involves understanding the specific parametric triggers and their potential vulnerabilities to moral hazard and adverse selection. The decision-making process should prioritize product design that inherently discourages adverse behavior, followed by rigorous underwriting and ongoing monitoring. When faced with potential issues, professionals must consult the relevant regulatory guidance and internal policies to ensure any mitigation strategies are compliant and ethically sound. A commitment to transparency with policyholders regarding the product's limitations and the insurer's risk management practices is also paramount. Question 6. Upon reviewing the proposed parametric insurance policy for a coastal resort, the underwriter notes that the insured peril is a combination of hurricane wind speed and storm surge height. The client has indicated that both factors contribute to their potential losses, but the impact of storm surge is generally more severe for their property. The underwriter is considering different methods for combining these two indices to determine the payout trigger. Which of the following methods best aligns with the principles of accurate risk representation and client transparency in parametric insurance? Option A. A sum of the storm surge and wind speed indices, where the payout is triggered if the sum exceeds a predetermined threshold. Option B. A weighted average of the storm surge and wind speed indices, with a higher weight assigned to the storm surge index based on its greater impact on the resort's losses. Option C. A simple average of the storm surge and wind speed indices, assuming both contribute equally to the insured peril. Option D. Selecting the index with the most readily available historical data, regardless of its direct correlation to the specific loss drivers for the resort. The correct answer is B. A weighted average of the storm surge and wind speed indices, with a higher weight assigned to the storm surge index based on its greater impact on the resort's losses. Explanation. This scenario presents a professional challenge because selecting the appropriate method for combining multiple indices in parametric insurance requires a nuanced understanding of the underlying risks, the client's specific needs, and the regulatory environment. Misjudging this can lead to a product that either inadequately covers the insured risk or is overly complex and difficult for the client to understand, potentially leading to disputes and regulatory scrutiny. The core of the challenge lies in balancing the desire for a comprehensive risk solution with the principles of transparency and fairness. The correct approach involves using a weighted average of the chosen indices, where the weights are determined by the relative contribution of each index to the overall insured peril. This method is professionally sound because it directly reflects the diversified nature of the risk being insured. For instance, if a business is exposed to both rainfall and wind speed, and rainfall is the primary driver of its losses, it should receive a higher weight. This approach aligns with regulatory expectations for clarity and accuracy in product design, ensuring that the trigger mechanism is a fair and representative reflection of the insured event. It promotes transparency by allowing the client to understand how different components of the risk are accounted for in the payout calculation. An incorrect approach would be to simply average the indices without considering their relative impact on the insured's losses. This fails to acknowledge that different components of a peril may have vastly different economic consequences. Ethically, this is problematic as it may lead to an inaccurate payout, either overcompensating or undercompensating the client, and violates the principle of providing a product that accurately reflects the risk. From a regulatory perspective, it could be seen as a misrepresentation of the product's functionality and a failure to act in the client's best interests. Another incorrect approach would be to use a simple sum of the indices, assuming each contributes equally to the loss. This is flawed because, as mentioned, the impact of different indices on losses is rarely uniform. This method lacks the sophistication to accurately model the risk and could lead to significant over- or underpayouts, creating potential for disputes and regulatory noncompliance due to the product's inaccuracy. A further incorrect approach would be to select indices based solely on data availability, without considering their direct relevance to the insured peril. While data availability is a practical consideration, the primary driver for index selection and weighting must be the accurate representation of the risk. Relying solely on available data, without a strong correlation to the insured event, would be a failure to design a product that effectively mitigates the client's specific risk, potentially leading to regulatory issues related to product suitability and effectiveness. Professionals should adopt a decision-making process that begins with a thorough understanding of the insured peril and its potential impact on the client. This involves detailed risk assessment and consultation with the client to understand their specific exposures. Subsequently, potential indices should be identified and evaluated for their correlation with the insured peril and their data reliability. The weighting methodology should then be chosen based on its ability to accurately reflect the relative contribution of each index to the overall risk, ensuring transparency and fairness. Finally, the chosen methodology and its rationale should be clearly communicated to the client, adhering to all relevant regulatory disclosure requirements. Question 7. Cost-benefit analysis shows that a new parametric insurance product for agricultural drought has the potential for higher profit margins due to its simplified payout structure, but there is a significant risk that the chosen rainfall index may not perfectly correlate with actual crop yield losses experienced by policyholders. Which approach best balances regulatory compliance, customer interests, and sound risk management? Option A. Rely solely on historical rainfall data to model potential payouts, assuming that past correlations will hold true for future events, and proceed with the simplified payout structure. Option B. Develop the product with the simplified payout structure, focusing marketing on the speed and certainty of payouts, and assume that any basis risk is an acceptable cost of doing business. Option C. Design the product with a more complex payout mechanism that directly measures crop yield losses, even if it increases administrative costs and slows down payout times, to minimize basis risk. Option D. Implement the simplified payout structure, but include extensive disclaimers in the policy wording and sales materials, clearly outlining the potential for basis risk and advising policyholders to seek independent advice on their specific crop yield exposure. The correct answer is B. Develop the product with the simplified payout structure, focusing marketing on the speed and certainty of payouts, and assume that any basis risk is an acceptable cost of doing business. Explanation. This scenario is professionally challenging because it requires balancing the potential benefits of a parametric insurance product against the inherent uncertainties and the need for robust risk management, all within the specific regulatory framework governing parametric insurance in the UK. The challenge lies in accurately quantifying and managing basis risk and other uncertainties to ensure the product is both viable for the insurer and provides genuine protection to the policyholder without misleading them about the coverage. Careful judgment is required to avoid overpromising or underdelivering on the insurance promise. The correct approach involves a comprehensive assessment of basis risk, considering the correlation between the trigger event and the actual loss, and developing clear, transparent communication strategies regarding any residual basis risk. This aligns with the Financial Conduct Authority's (FCA) principles, particularly Principle 6, Customers' Interest, and Principle 7, Communications with Clients, which mandate that firms must act honestly, fairly, and professionally in accordance with the best interests of their clients. It also reflects the need for sound risk management practices as outlined in the Prudential Regulation Authority's PRA Solvency Roman II requirements, which emphasize the importance of understanding and managing all material risks, including basis risk in complex insurance products. An incorrect approach that focuses solely on the potential for higher profit margins without adequately addressing basis risk fails to uphold the duty to act in the customer's best interests. This could lead to policyholders experiencing losses that are not fully covered by the parametric trigger, creating a significant gap between their perceived protection and actual outcomes. Such a failure would contravene FCA principles and potentially lead to regulatory action for mis-selling or inadequate product governance. Another incorrect approach that prioritizes simplicity in product design over accurate risk assessment, leading to a product that is easy to understand but does not adequately reflect the underlying risks, also falls short. Clarity is important. It cannot come at the expense of ensuring the product provides meaningful protection and that the policyholder is aware of the limitations. This would also be a breach of FCA principles regarding fair treatment of customers and transparency. A further incorrect approach that relies on historical data without robust stress testing or scenario analysis for basis risk is also problematic. While historical data is a valuable input, it may not adequately capture future volatility or extreme events, which are crucial for parametric insurance. Failing to adequately stress test the product's performance under various adverse conditions could lead to unexpected losses for the insurer and, consequently, potential issues for policyholders if the insurer's solvency is impacted. This would be a failure in prudent risk management, which is a core regulatory expectation. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly understand the specific risks associated with the parametric trigger and the potential for basis risk. Second, engage in robust quantitative and qualitative analysis to assess the magnitude and impact of these risks. Third, develop clear and transparent communication materials that accurately explain the product's coverage, limitation, and any residual basis risk to potential policyholders. Fourth, ensure that the product design and pricing reflect a prudent assessment of these risks, aligning with regulatory expectations for fair treatment of customers and sound financial management. Question 8. Performance analysis shows that a significant number of parametric insurance claims are being processed with a high degree of efficiency, but there is a concern that the speed of processing might be compromising the accuracy of trigger event verification against specific policy terms. In a scenario where a weather event has occurred and preliminary reports suggest a potential trigger, what is the most appropriate approach to ensure both regulatory compliance and fair treatment of the policyholder? Option A. Conduct a thorough review of the independent data provider's official report, cross-referencing the specific trigger parameters defined in the policy wording to confirm the event's occurrence and magnitude. Option B. Immediately approve the claim based on the preliminary reports to maintain high processing speed and customer satisfaction. Option C. Adjust the policy's trigger definition to align with the observed impact of the event, as the preliminary reports indicate a loss. Option D. Rely solely on the internal assessment team's judgment of the event's severity, without consulting the independent data provider's official report. The correct answer is B. Immediately approve the claim based on the preliminary reports to maintain high processing speed and customer satisfaction. Explanation. Scenario analysis. This scenario is professionally challenging because it requires balancing the need for efficient claims processing with the fundamental principles of insurance, particularly the duty of utmost good faith and the accurate representation of policy terms. Parametric insurance, by its nature, relies on objective triggers, but the interpretation and application of these triggers, especially in novel or complex situations, demand careful judgment to ensure fairness to both the policyholder and the insurer. Misinterpreting or misapplying policy terms can lead to disputes, regulatory scrutiny, and damage to the firm's reputation. Correct approach analysis. The correct approach involves a thorough review of the specific parametric trigger conditions as defined in the policy wording and cross-referencing them with the available data from the independent data provider. This ensures that the claim payout is strictly aligned with the contractual agreement. The regulatory framework for insurance, particularly under the FCA's Principles for Businesses, PRIN, mandates that firms must act honestly, fairly, and professionally in accordance with the best interests of their customers. PRIN 6 requires firms to pay due regard to the interests of their customers and treat them fairly. In the context of parametric insurance, this means adhering precisely to the predefined trigger mechanisms to avoid arbitrary decisions that could disadvantage the policyholder. The absence of ambiguity in the policy wording and the reliance on objective data are cornerstones of parametric insurance, and upholding these principles is paramount. Correct approaches analysis. An approach that prioritizes speed over accuracy by assuming the trigger has been met without verifying the data against the policy's specific parameters fails to uphold the duty of utmost good faith. This could lead to an incorrect payout, either overpaying or underpaying the claim, both of which are detrimental. Overpaying could expose the insurer to financial losses and potentially violate solvency regulations if it becomes a pattern. Underpaying would be a clear breach of PRIN 6, treating the customer unfairly. Another incorrect approach would be to adjust the trigger definition post-event to accommodate the observed data. This is a direct violation of the contractual agreement and the principle of fairness. The FCA's rules prohibit firms from treating customers unfairly, and retrospectively altering policy terms to justify a payout or denial is unethical and likely breaches multiple regulatory requirements, including those related to clear communication and fair treatment of customers. Furthermore, relying solely on an internal assessment without consulting the independent data provider or the explicit policy wording introduces a significant risk of misinterpretation. This bypasses the objective data source that forms the basis of the parametric contract and could lead to decisions that are not grounded in the agreed-upon terms, thus failing to treat customers fairly and potentially breaching PRIN 3 fitness and propriety if it indicates a lack of competence. Professional reasoning. Professionals in parametric insurance must adopt a systematic and evidence-based approach to claims assessment. This involves 1. Understanding the policy, a deep comprehension of the specific trigger conditions, thresholds, and data sources outlined in the policy wording. 2. Data verification, rigorous verification of data provided by the independent source against the policy's defined parameters. 3. Consultation, seeking clarification from underwriting or legal teams if any ambiguity exists in the policy wording or data interpretation. 4. Fairness and transparency, ensuring that the decision-making process is fair, transparent, and consistently applied, adhering to the principles of treating customers fairly. 5. Documentation, maintaining clear and comprehensive records of the assessment process, data used, and the rationale for the decision. This structured approach ensures compliance with regulatory obligations, maintains customer trust, and upholds the integrity of the parametric insurance product. Question 9. Implementation of a new parametric insurance product line focused on climate-related events necessitates a review of the insurer's risk transfer strategy. Considering the potential for large, correlated payouts and the need to maintain robust solvency margins, which of the following reinsurance approaches would best optimize the insurer's capital efficiency and risk management framework in line with UK regulatory expectations? Option A. Purchasing a catastrophe excessive loss reinsurance treaty that covers losses exceeding a predetermined threshold for a specific peril, offering protection against extreme, infrequent events. Option B. Establishing a collateralized reinsurance arrangement, where a trust is funded with assets to collateralize the reinsurer's obligations, providing an additional layer of security for the insurer. Option C. Securing a quota-share reinsurance treaty that cedes a fixed percentage of all premiums and claims for the new product line, ensuring a predictable reduction in net exposure and freeing up capital for underwriting growth. Option D. Entering into a facultative reinsurance agreement for each individual large policy issued under the new product line, providing granular control over risk transfer for specific high-value risks. The correct answer is C. Securing a quota-share reinsurance treaty that cedes a fixed percentage of all premiums and claims for the new product line, ensuring a predictable reduction in net exposure and freeing up capital for underwriting growth. Explanation. This scenario presents a professional challenge for an insurer seeking to manage its risk exposure through reinsurance. The challenge lies in selecting the most appropriate type of reinsurance that not only aligns with the insurer's strategic objectives, but also adheres to the regulatory framework governing insurance and reinsurance operations within the specified jurisdiction, assumed to be the UK, given the CISI context. A deep understanding of the functions and benefits of different reinsurance types is crucial for making a decision that optimizes capital efficiency, solvency, and operational stability, all while maintaining compliance. The correct approach involves selecting a reinsurance structure that directly addresses the insurer's specific risk appetite and capital management goals, such as mitigating volatility in claims from parametric triggers. This would likely involve a form of proportional or non-proportional reinsurance designed to transfer a defined portion of risk and premium, thereby enhancing the insurer's capacity to underwrite larger or more complex parametric policies and ensuring solvency margins are maintained. The regulatory framework, particularly as guided by the Financial Conduct Authority, FCA, and Prudential Regulation Authority, PRA in the UK, emphasizes robust risk management and adequate capitalization. Reinsurance, when structured appropriately, is a key tool for achieving these objectives. The benefit of such a structure is that it provides a predictable and quantifiable reduction in the insurer's net exposure to specific parametric event risks, allowing for more efficient capital allocation and potentially improving profitability, by reducing the need for excessive retained earnings to cover extreme events. An incorrect approach would be to opt for a reinsurance solution that does not adequately transfer the intended risk, perhaps due to misaligned triggers or coverage limitations, or one that is overly complex and difficult to manage, leading to operational inefficiencies and potential regulatory scrutiny. For instance, choosing a reinsurance treaty that only covers a small, fixed portion of losses might not provide sufficient protection against the potential for large, correlated parametric payouts, leaving the insurer exposed to significant financial strain. This would fail to meet the regulatory expectation of prudent risk management and could jeopardize the insurer's solvency. Another incorrect approach might involve a reinsurance arrangement that is not cost-effective, consuming a disproportionate amount of premium without providing commensurate risk mitigation benefits. This could lead to a reduction in the insurer's profitability and potentially impact its ability to meet its obligations to policyholders, which is a direct contravention of regulatory principles. Furthermore, failing to ensure that the reinsurer itself is financially sound and appropriately regulated could also be a significant regulatory failure, as the insurer remains ultimately responsible for its policyholder obligations. The professional decision-making process should involve a thorough assessment of the insurer's current risk profile, its strategic growth plans, and its capital position. This assessment should then be mapped against the various reinsurance options available, considering their impact on risk transfer, capital requirements, and operational complexity. A key step is to consult with reinsurance brokers and legal counsel to ensure the chosen structure is compliant with all relevant regulations, including Solvency II requirements where applicable, and that the terms and conditions of the reinsurance contract are clearly understood and appropriately reflect the risks being transferred. The insurer must also conduct due diligence on potential reinsurers to ensure their financial strength and reputation. Question 10. Which approach would be most appropriate for validating the accuracy of a parametric insurance index, ensuring it reliably reflects the insured peril and meets regulatory expectations? Option A. Focusing on the index's historical performance in terms of payout frequency, without a deep dive into the statistical relationship between the index and the underlying risk event. Option B. Accepting the index validation provided by the data vendor, assuming their expertise guarantees the index's accuracy. Option C. Conducting a comprehensive statistical analysis of historical data to assess the index's correlation with the actual insured peril, its volatility, and its sensitivity to trigger events, alongside independent verification of data sources. Option D. Prioritizing the ease of data acquisition and the simplicity of the index's calculation, even if it means a less direct correlation with the insured peril. The correct answer is C. Conducting a comprehensive statistical analysis of historical data to assess the index's correlation with the actual insured peril, its volatility, and its sensitivity to trigger events, alongside independent verification of data sources. Explanation. This scenario is professionally challenging because the accuracy and reliability of the parametric index are fundamental to the integrity of the insurance product and the trust placed in the insurer by policyholders and regulators. Inaccurate index validation can lead to underpayment of claims, causing financial hardship for policyholders, or overpayment, impacting the insurer's solvency and market reputation. Regulators expect a robust and transparent process for ensuring that the chosen index accurately reflects the underlying risk event. The correct approach involves a comprehensive statistical analysis of historical data to assess the index's correlation with the actual insured peril and its volatility. This includes examining the index's sensitivity to the defined trigger event, its consistency over time, and its ability to avoid spurious triggers. This rigorous statistical validation is crucial for demonstrating to regulators that the index is a fair and accurate representation of the insured risk, thereby fulfilling the insurer's duty of care and adhering to principles of good governance and consumer protection, as mandated by regulatory frameworks governing insurance product design and oversight. An approach that relies solely on the vendor's assurance without independent statistical verification fails to meet the required standard of due diligence. This represents a significant regulatory failure, as it abdicates the insurer's responsibility to independently assess the suitability of a critical product component. Ethically, It is unacceptable to rely on third-party claims of accuracy without substantiation, as it potentially exposes policyholders to unfair outcomes. An approach that focuses only on the ease of data acquisition for the index, without regard for its statistical accuracy or correlation to the insured peril, is also professionally unacceptable. This demonstrates a disregard for the core purpose of the index to accurately measure the trigger event. Such a focus would likely lead to an index that is either too sensitive or not sensitive enough, resulting in either frequent, unwarranted payouts or a failure to pay when a genuine claim event occurs, both of which are detrimental to policyholder trust and regulatory compliance. Finally, an approach that prioritizes the simplicity of the index's calculation over its statistical validity, even if it means a weaker correlation to the actual risk, is also flawed. While simplicity can be beneficial for transparency, it cannot come at the expense of accuracy. Regulators expect a demonstrable link between the index and the insured peril, and an overly simplified index that fails to capture the nuances of the risk would be seen as a failure to adequately design the product to meet its stated purpose. Professionals should adopt a decision-making framework that begins with clearly defining the insured peril and the desired outcome for policyholders. This should be followed by an objective assessment of potential index methodologies, prioritizing those with a strong theoretical basis and a proven track record of correlation with the peril. Rigorous statistical validation, including backtesting and sensitivity analysis, should be a mandatory step before product launch. Ongoing monitoring and periodic revalidation are also essential to ensure continued accuracy and relevance. Question 11. The analysis reveals that a parametric insurance policy was issued to a business for losses resulting from a hurricane. The contract defines the trigger event as a Category 4 or higher hurricane making landfall within 100 miles of the insured's primary facility. The designated data source for hurricane intensity is the National Hurricane Center, NHC, advisories. Following a significant storm, the NHC advisories indicate a Category 3 hurricane at landfall, but a subsequent independent meteorological analysis, commissioned by the insured, suggests the storm reached Category 4 intensity at the point of landfall. The insured submits a claim, asserting the contract should be enforced based on the independent analysis. Which approach best ensures the enforceability of the parametric insurance contract in this scenario? Option A. Seek to renegotiate the trigger event definition with the insured to accommodate the independent analysis, acknowledging the potential for data discrepancies. Option B. Deny the claim, as the designated data source, NHC advisories, did not confirm the trigger event, and the contract explicitly specifies this source. Option C. Enforce the contract based on the independent meteorological analysis, as it indicates the trigger event occurred and aligns with the insured's expectation of coverage. Option D. Advise the insured that parametric insurance contracts are inherently subjective and that disputes over trigger events are common, suggesting a settlement based on a compromise. The correct answer is C. Enforce the contract based on the independent meteorological analysis, as it indicates the trigger event occurred and aligns with the insured's expectation of coverage. Explanation. The analysis reveals a scenario that is professionally challenging due to the inherent complexity of parametric insurance contracts and the potential for disputes arising from the interpretation of trigger events and data sources. Parametric insurance, by its nature, relies on objective, predefined triggers and data feeds, which can be subject to interpretation, data availability issues, or disputes over the accuracy of the data itself. This necessitates a robust understanding of contract law principles, specifically concerning enforceability, to ensure that both the insurer and the insured have clear expectations and recourse. Careful judgment is required to navigate the intersection of insurance contract terms, regulatory compliance, and the practical application of parametric triggers. The correct approach involves a thorough review of the parametric insurance contract's specific wording, focusing on the definition of the trigger event, the designated data source, and the agreed-upon payout mechanism. This approach aligns with the fundamental principles of contract law, which emphasize the importance of clear and unambiguous terms for enforceability. In the context of parametric insurance, regulatory frameworks, such as those governing insurance contracts in the UK, e.g., the Insurance Act 2015, the Financial Conduct Authorities, FCA, Conduct of Business Sourcebook COBS, mandate that contracts are fair, clear, and not misleading. Enforceability hinges on whether the contract's terms, when applied to the factual circumstances, meet these standards. A contract is generally enforceable if there is a clear offer, acceptance, consideration, and intention to create legal relations, and if its terms are sufficiently certain. For parametric contracts, certainty is achieved through precise definitions of triggers and data. An incorrect approach would be to assume enforceability based solely on the existence of a signed contract, without scrutinizing the trigger mechanism and data source. This fails to address the potential for ambiguity or the absence of a clear, objective trigger event, which could render the contract unenforceable due to uncertainty. Regulatory failure here would stem from a lack of due diligence in ensuring the contract's terms are sufficiently precise to meet the FCA's requirements for clarity and fairness, potentially leading to misrepresentation or a failure to act with due skill, care, and diligence. Another incorrect approach would be to rely on industry custom or general insurance principles without reference to the specific parametric contract's terms. While industry practice can inform interpretation, it cannot override explicit contractual provisions. This approach risks misinterpreting the parties' intentions and the specific obligations agreed upon, potentially leading to disputes over coverage and a failure to adhere to the contract's precise stipulations. This could also lead to a breach of regulatory obligations to act in the customer's best interests, as the contract's specific terms would not be adequately considered. A further incorrect approach would be to prioritize the insurer's internal claims handling procedures over the explicit terms of the parametric contract. While internal procedures are important for operational efficiency, they must be consistent with the contractual obligations. If internal procedures lead to a denial of a claim that is clearly covered by the contract's parametric trigger, it would constitute a breach of contract and potentially a regulatory breach for unfair treatment of customers. The professional decision-making process for similar situations should involve a systematic review of the contract, identifying all key parametric elements: trigger, data source, payout. This should be followed by an objective assessment of whether the trigger event, as defined, has occurred based on the agreed-upon data source. Any ambiguities or potential disputes should be identified and addressed by referring back to the contract's precise wording and relevant legal principles. Professionals must always ensure that their actions and advice are grounded in the specific contractual terms and comply with all applicable regulatory requirements, such as those set out by the FCA, to uphold the enforceability and integrity of parametric insurance products. Question 12. The monitoring system demonstrates that a significant seismic event has occurred, registering a magnitude of 6.5 on the Richter scale. The parametric insurance policy held by a commercial property owner in the affected region has a trigger event defined as an earthquake with a magnitude of 6.0 or greater. The policy's payout structure is currently under review for its suitability in this scenario. Considering the principles of parametric insurance and regulatory expectations for clarity and fairness, which payout structure would best align with the policy's intent and regulatory compliance? Option A. A nonlinear payout function, where the payout increases exponentially with each incremental increase in earthquake magnitude above 6.0. Option B. A stepwise payout function that provides a fixed payout only if the earthquake magnitude exceeds 7.0 with no payout for magnitudes between 6.0 and 7.0. Option C. A linear payout function where the payout increases proportionally with the magnitude of the earthquake above a predefined baseline. Option D. A payout structure that requires a physical inspection of the property damage to determine the payout amount, irrespective of the earthquake's magnitude. Correct answer is C. A linear payout function where the payout increases proportionally with the magnitude of the earthquake above a predefined baseline. Explanation. This scenario presents a professional challenge because it requires the insurance professional to interpret complex payout structures in the context of a specific parametric trigger event, ensuring that the chosen structure aligns with the policyholder's needs and regulatory expectations for clarity and fairness. The challenge lies in selecting a payout function that accurately reflects the risk being insured and is easily understood by the policyholder, avoiding ambiguity that could lead to disputes. The correct approach involves selecting a payout structure that clearly and directly links the observed trigger event to the payout amount, in a manner that is transparent and predictable for the policyholder. For a parametric insurance policy designed to cover losses from a specific weather event, a linear payout function is often the most appropriate and professionally sound choice. This is because a linear function provides a straightforward, proportional relationship between the intensity of the trigger event, e.g., wind speed, rainfall amount, and the payout. This proportionality ensures that the payout directly reflects the severity of the event, offering a clear and easily understandable mechanism for the policyholder. From a regulatory and ethical standpoint, this transparency is crucial. It aligns with principles of fair dealing and ensures that the policyholder can readily understand how their coverage operates and what to expect in the event of a claim, thereby minimizing the potential for misunderstandings or disputes. This approach upholds the duty of care owed to the policyholder. An incorrect approach would be to select a nonlinear payout function without clear justification or adequate disclosure. For instance, a steeply increasing nonlinear function might pay out disproportionately more for minor increases in the trigger event's intensity, potentially leading to overpayment relative to the actual loss experienced or creating an expectation of coverage that is not actuarially sound. This lack of proportionality can be seen as unfair to the insurer and potentially misleading to the policyholder if not fully explained. Furthermore, a complex nonlinear function can be difficult for the policyholder to understand, potentially violating regulatory requirements for clarity and transparency in insurance contracts. Another incorrect approach would be to opt for a stepwise payout function that offers a fixed payout only once a certain threshold of the trigger event is met, with no payout for events below that threshold, regardless of their proximity to it. While this can be a valid structure in some specific parametric designs, if the underlying risk is more continuous, a stepwise function can create a cliff effect, where a minor difference in the trigger event's intensity results in a complete absence of a payout. This can be perceived as arbitrary and unfair by the policyholder, especially if the event, while not meeting the threshold, still caused some level of disruption or loss. Such a structure, if not meticulously designed and clearly communicated, could lead to regulatory scrutiny for failing to provide adequate and equitable coverage for the insured risk. The professional decision-making process for similar situations should involve a thorough understanding of the policyholder's specific needs and risk profile, a clear assessment of the trigger event's characteristics, and a careful consideration of the regulatory requirements for transparency and fairness. Professionals must prioritize payout structures that are both actuarially sound and easily comprehensible to the policyholder, ensuring that the chosen mechanism accurately reflects the insured risk and provides a clear, predictable outcome in the event of a claim. This involves evaluating the proportionality, transparency, and fairness of each potential payout structure against these core principles. Question 13. Governance review demonstrates that the firm is developing a new parametric insurance product. The product's payout is directly linked to a specific weather index. To expedite market entry, the product development team proposes to include only a brief overview of the index methodology in the policy documentation, with a disclaimer that detailed information is available from the index provider upon request. Which of the following approaches best aligns with regulatory expectations for index transparency and customer protection in the context of parametric insurance? Option A. Develop and maintain comprehensive, clear, and readily accessible documentation for the parametric index, detailing data sources, calculation methodologies, historical performance, and potential limitations, and ensure this is integrated into policyholder communications. Option B. Assume policyholders will proactively seek clarification on index details if they are confused, and only provide information when specifically asked. Option C. Provide only the index provider's generic, technical documentation without any specific tailoring or simplification for policyholder understanding. Option D. Include a high-level summary of the index methodology in the policy documentation, and rely on a disclaimer for policyholders to request further details from the index provider. The correct answer is A. Develop and maintain comprehensive, clear, and readily accessible documentation for the parametric index, detailing data sources, calculation methodologies, historical performance, and potential limitations, and ensure this is integrated into policyholder communications. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient product development with the fundamental regulatory and ethical obligation to ensure policyholders fully understand the parametric triggers and their implications. The complexity of parametric insurance, particularly the reliance on external data for index performance, necessitates a high degree of transparency. Failure to adequately document and communicate index methodology can lead to disputes, regulatory scrutiny, and reputational damage. Careful judgment is required to ensure that the documentation, while comprehensive, is also accessible and understandable to the intended audience. The correct approach involves developing and maintaining comprehensive, clear, and readily accessible documentation for the parametric index. This documentation should detail the data sources, calculation methodologies, historical performance, and any potential limitations or biases of the index. This aligns with regulatory principles that emphasize fair treatment of customers and the need for clear communication of product terms and conditions. Specifically, it supports the spirit of regulations requiring transparency in financial products, ensuring that policyholders can make informed decisions and understand the basis of their coverage. This proactive approach mitigates the risk of misinterpretation and disputes, fostering trust and compliance. An incorrect approach that prioritizes speed over clarity, by providing only a high-level summary of the index methodology, fails to meet regulatory expectations for transparency. This omission can lead to policyholders being unaware of critical details that affect their coverage, potentially resulting in claims being denied or payouts being lower than anticipated. This constitutes a failure in fair customer treatment and can attract regulatory sanctions for inadequate disclosure. Another incorrect approach, which relies solely on the index provider's generic documentation without tailoring it for policyholder understanding, is also professionally unacceptable. While the provider's documentation may be technically accurate, it is unlikely to be written with the specific needs and comprehension levels of the policyholder in mind. This can lead to confusion and a lack of understanding, creating a similar risk of misinterpretation and disputes as the first incorrect approach, and failing to uphold the insurer's duty of care. A further incorrect approach that assumes policyholders will seek clarification on index details if they are confused, rather than proactively providing clear documentation, shifts the burden of understanding unfairly onto the policyholder. This passive stance neglects the insurer's responsibility to ensure clarity and can lead to a perception of opacity, undermining customer confidence and potentially violating regulatory requirements for proactive disclosure. The professional decision-making process for similar situations should involve a risk-based assessment of information needs. This means identifying what information is critical for a policyholder to understand their coverage and the basis of any payout. It requires a commitment to clear, concise, and accessible communication, even if it adds complexity to the product development process. Professionals should consult relevant regulatory guidance on disclosure and transparency, and consider the potential impact of information gaps on customer outcomes and the firm's reputation. Question 14. The performance metrics show that parametric insurance policies are settling claims significantly faster than traditional insurance policies, leading to quicker capital infusion for businesses affected by specific, predefined events. A client, a small business owner in a region prone to sudden, intense hailstorms, is considering purchasing insurance. They are concerned about the immediate financial impact of property damage from such events. When discussing insurance options, the advisor presents a parametric policy that pays out a fixed sum upon a certified hail event of a certain intensity in their postcode, alongside a traditional property damage policy that indemnifies actual losses. Which of the following approaches best reflects the regulatory expectations for advising on these products within the Certificate in Parametric Insurance framework? Option A. Focus exclusively on the parametric policy's trigger mechanism and payout amount, highlighting its simplicity and efficiency, and advise the client that this is the most modern and effective form of insurance available for their situation. Option B. Emphasize the speed of payout of the parametric policy as the primary benefit, assuring the client that this rapid capital injection will solve their immediate financial concerns, and downplay the complexities of traditional insurance. Option C. Recommend only the traditional insurance policy, arguing that it provides more comprehensive coverage by indemnifying actual losses, and dismiss the parametric policy as being too simplistic and potentially inadequate for true risk mitigation. Option D. Present both the parametric and traditional insurance options, clearly explaining the advantages and disadvantages of each, including the parametric policy's fixed payout structure, potential for basis risk, and the traditional policy's indemnification of actual losses, allowing the client to make an informed decision based on their specific needs and risk tolerance. Correct answer is B. Emphasize the speed of payout of the parametric policy as the primary benefit, assuring the client that this rapid capital injection will solve their immediate financial concerns and downplay the complexities of traditional insurance. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of the regulatory landscape governing insurance products, specifically the certificate in parametric insurance framework, and the ability to critically evaluate the advantages and disadvantages of parametric insurance compared to traditional insurance within that framework. The challenge lies in identifying the most appropriate regulatory and ethical considerations when advising a client on product suitability, ensuring that the advice aligns with the principles of fair treatment of customers and robust risk management, as mandated by the relevant regulatory body. The correct approach involves recognizing that parametric insurance, while offering speed and efficiency, may not be suitable for all risks or all clients. A thorough assessment of the client's specific needs, risk appetite, and understanding of the product's triggers and limitations is paramount. This aligns with regulatory expectations that advisors must act in the best interests of their clients, providing clear, accurate, and understandable information. The regulatory framework for the certificate in parametric insurance likely emphasizes transparency regarding the basis of payouts, the potential for basis risk, the risk that the trigger event occurs but the actual loss is different from the payout, and the need for clients to have a clear understanding of how the product functions. Therefore, a balanced presentation of both advantages and disadvantages, tailored to the client's circumstances, is the most professionally sound and regulatorily compliant course of action. An incorrect approach that focuses solely on the speed of payouts without adequately addressing potential limitations or the client's specific needs fails to meet the duty of care expected by regulators. This could lead to client dissatisfaction and potential regulatory breaches if the client suffers a loss that is not covered as expected due to a misunderstanding of the parametric trigger. Another incorrect approach that dismisses parametric insurance entirely without a proper evaluation of its potential benefits for specific risks would be a failure to provide a comprehensive advisory service. This could be seen as a lack of diligence and an inability to offer innovative solutions that might be appropriate and beneficial to the client, potentially contravening principles of providing suitable advice. Professionals should adopt a decision-making process that begins with a comprehensive understanding of the client's situation and objectives. This should be followed by a detailed analysis of the product's features, benefits, and limitations, specifically in the context of the relevant regulatory framework. The comparison with traditional insurance should be objective and client-centric, highlighting how each product type addresses the client's needs and risks. Finally, the recommendation should be clearly communicated, ensuring the client understands the rationale behind the chosen product and its implications. Question 15. Quality control measures reveal that a parametric insurance firm, operating under UK regulations, stores policyholder data and claims trigger information in a cloud-based database. The firm is considering an upgrade to its data management system and needs to select the most appropriate strategy for data storage and governance. Which of the following approaches best aligns with regulatory requirements and professional best practices for data storage and management in this context? Option A. Migrate all data to a new cloud storage solution that offers end-to-end encryption, automated daily backups to a separate geographic location, and granular access controls based on user roles, with a comprehensive data retention policy in place. Option B. Share anonymized historical claims data with a marketing partner to identify potential new product development opportunities, without seeking explicit consent from policyholders for this secondary use of data. Option C. Continue using the current cloud storage solution, but implement a basic password protection system for all user accounts and conduct manual data backups once a month. Option D. Store all sensitive policyholder data on local, unencrypted hard drives within the office premises and rely on the office's physical security to protect the data. The correct answer is A. Migrate all data to a new cloud storage solution that offers end-to-end encryption, automated daily backups to a separate geographic location, and granular access controls based on user roles, with a comprehensive data retention policy in place. Explanation. This scenario presents a professional challenge due to the critical nature of data integrity and security in parametric insurance. The firm's reliance on accurate and accessible data for triggering payouts and managing client information necessitates robust data storage and management practices. Failure in these areas can lead to financial losses, regulatory penalties, and severe reputational damage. The challenge lies in balancing operational efficiency with stringent regulatory compliance and ethical obligations to policyholders. The correct approach involves implementing a comprehensive data governance framework that encompasses secure cloud storage with robust encryption, regular data backups, and strict access controls, all aligned with relevant data protection regulations. This ensures data confidentiality, integrity, and availability, which are paramount for regulatory compliance and client trust. Specifically, adhering to data protection principles such as lawful processing, purpose limitation, data minimization, accuracy, storage limitation, integrity and confidentiality, and accountability as mandated by regulations like the UK GDPR is essential. This approach directly addresses the need for secure, reliable, and compliant data handling. An incorrect approach that relies solely on basic cloud storage without encryption or regular backups exposes sensitive policyholder data to unauthorized access and potential loss. This violates the principle of integrity and confidentiality, and potentially the accountability principle, leading to breaches of data protection laws and a loss of client trust. Another incorrect approach that involves storing all data on local, unencrypted servers without a disaster recovery plan creates significant risks of data loss due to hardware failure or physical security breaches. This fails to meet the integrity and confidentiality requirements and demonstrates a lack of preparedness for business continuity, contravening regulatory expectations for operational resilience. A third incorrect approach that involves sharing raw, unanonymized data with third-party analytics providers without explicit consent or a data processing agreement is a severe breach of data privacy regulations. This violates principles of lawful processing, purpose limitation, and confidentiality, exposing the firm to significant legal and financial repercussions. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and ethical considerations. This involves proactively identifying data risks, understanding the specific requirements of applicable data protection laws, and implementing controls that mitigate these risks. Regular audits, staff training on data handling best practices, and a clear understanding of data lifecycle management are crucial components of this framework. When faced with data storage and management decisions, professionals must ask, does this approach ensure the confidentiality, integrity, and availability of data? Does it comply with all relevant data protection regulations? Does it uphold our ethical obligations to policyholders? Question 16. Consider a scenario where a parametric insurance policy for a business in Florida is triggered by hurricane intensity, specifically defined as sustained wind speeds exceeding 120 mph at the insured property's location. Upon the passage of Hurricane Tempest, initial news reports and social media posts suggest widespread devastation, with some unofficial sources claiming wind speeds far exceeding the trigger threshold. However, the official meteorological agency's preliminary report indicates sustained winds at the property's location were around 110 mph, with gusts reaching higher, but the official sustained wind speed metric for the trigger has not yet been definitively confirmed by the agency's final analysis. What is the most appropriate professional approach for the parametric insurer to take in deciding whether to activate the policy payout? Option A. Reject the claim outright, citing the preliminary official report that indicates sustained winds were below the trigger threshold, and advise the policyholder to seek compensation from other sources. Option B. Defer the payout decision until the official meteorological agency releases its final, confirmed report on sustained wind speeds at the insured property's location, cross-referencing with other credible, objective data sources that directly measure the trigger parameter. Option C. Initiate a negotiation with the policyholder to adjust the payout amount based on the observed damage, even though the official sustained wind speed data is not yet finalized. Option D. Activate the policy payout immediately based on the widespread reports of devastation and the potential for higher, unconfirmed wind speeds to ensure prompt relief for the policyholder. The correct answer is D. Activate the policy payout immediately based on the widespread reports of devastation and the potential for higher, unconfirmed wind speeds to ensure prompt relief for the policyholder. Explanation: this scenario is professionally challenging because it requires the parametric insurance provider to make a critical decision regarding the activation of a hurricane-related parametric insurance policy based on potentially conflicting or ambiguous data regarding hurricane intensity. The core challenge lies in ensuring that the decision aligns strictly with the defined trigger parameters in the policy contract and adheres to the regulatory framework governing insurance products in the specified jurisdiction, which in this case is assumed to be the UK, adhering to FCA principles and relevant insurance law. The correct approach involves a meticulous review of all available, credible data sources that directly measure the defined trigger parameter hurricane intensity. This includes official meteorological agency reports, e.g., from the National Hurricane Center or equivalent UK meteorological bodies if applicable to the insured peril's location, satellite imagery analysis, and potentially independent third-party verification services, all of which must be demonstrably linked to the policy's specific intensity metric, e.g., Saffir-Simpson scale category, sustained wind speed at specific location. The regulatory justification stems from the FCA's principles for businesses, particularly Principle 6, Customers' Interests, and Principle 7, Communications with Clients, which mandate that firms act honestly, fairly, and professionally in accordance with the best interests of their customers. A decision based on robust, verifiable data that directly matches the policy's trigger criteria upholds the contractual agreement and ensures fair treatment of the policyholder. An incorrect approach would be to rely on anecdotal evidence or preliminary, unverified reports of hurricane damage to infer intensity. This fails to meet the contractual requirement for objective, measurable data and could lead to an unjustified payout or denial of a valid claim, violating FCA Principle 6. Another incorrect approach is to interpret the trigger parameter loosely or to make a decision based on the perceived severity of the event rather than the precise, predefined metric. This demonstrates a failure to act with due skill, care, diligence, FCA Principle 2, and undermines the integrity of the parametric insurance product. Furthermore, delaying a decision or seeking to renegotiate terms post-event based on emerging information not tied to the original trigger would be a clear breach of contract and regulatory expectations for fair dealing. Professionals should employ a decision-making framework that prioritizes data integrity, contractual adherence, and regulatory compliance. This involves establishing clear protocols for data verification, defining the hierarchy of acceptable data sources for each trigger, and ensuring that all decision-makers are thoroughly trained on the policy's specific trigger conditions and the relevant regulatory obligations. In situations of ambiguity, the framework should mandate seeking clarification from the policyholder or engaging independent experts to interpret data against the contractual trigger, always erring on the side of transparency and fairness to the customer. Question 17. Market research demonstrates a growing demand for parametric insurance products that offer rapid payouts for specific weather-related events. An insurer is developing a new parametric policy for agricultural businesses, designed to pay out when rainfall exceeds a predefined threshold. The insurer must determine the maximum payout amount, or exhaustion point, for this policy. Which of the following approaches best aligns with the principles of fair customer treatment and sound risk management expected under the certificate in parametric insurance regulatory framework? Option A. Setting the exhaustion point based on a quick estimation of the average annual rainfall in the target region, without detailed analysis of extreme event probabilities or specific crop vulnerabilities. Option B. Setting the exhaustion point based on a statistical analysis of historical rainfall data, considering a range of potential extreme events and their likely financial impact on the policyholder's specific crops and farm operations, ensuring the payout limit provides meaningful protection against catastrophic losses. Option C. Setting the exhaustion point at the highest possible figure that the insurer can afford to pay without requiring any external reinsurance, to offer the most generous coverage possible to attract market share. Option D. Setting the exhaustion point at a level that is easily achievable for most common rainfall events, aiming to maximize the number of small payouts to demonstrate the policy's responsiveness, even if it means the maximum payout is insufficient for truly devastating events. The correct answer is B. Setting the exhaustion point based on a statistical analysis of historical rainfall data, considering a range of potential extreme events and their likely financial impact on the policyholder's specific crops and farm operations. Ensuring the payout limit provides meaningful protection against catastrophic losses. Explanation: this scenario is professionally challenging because accurately defining the exhaustion point for a parametric insurance policy requires a delicate balance between providing sufficient coverage to the policyholder and managing the insurer's risk exposure. Misjudging this point can lead to either underinsurance, leaving the policyholder exposed to significant losses beyond the payout limit, or overinsurance, where the insurer bears an unsustainable financial burden. The Certificate in Parametric Insurance exam emphasizes understanding how policy terms, including the exhaustion point, align with regulatory expectations for fair treatment of customers in solvency. The correct approach involves a thorough, data-driven assessment of potential loss scenarios and the policyholder's specific needs, ensuring the exhaustion point is clearly defined and communicated. This aligns with regulatory principles that mandate clear and transparent policy terms, preventing ambiguity and ensuring policyholders understand the extent of their coverage. Specifically, it reflects the duty of care owed to policyholders to provide products that meet their reasonable expectations and are not misleading. The exhaustion point must be set at a level that provides meaningful protection without creating an unmanageable risk for the insurer, thereby upholding the principle of offering a sound and viable insurance product. An incorrect approach that relies solely on historical average payouts without considering extreme but plausible events fails to adequately protect the policyholder. This could be seen as a breach of the duty to offer appropriate coverage and may violate regulations requiring insurers to assess and manage risks comprehensively. Another incorrect approach that sets the exhaustion point arbitrarily low, without a clear rationale tied to the underlying risk, could be deemed misleading and potentially predatory, failing to meet the policyholder's reasonable expectations of coverage and violating principles of fair dealing. Setting the exhaustion point too high without adequate reinsurance or capital backing could also pose a solvency risk to the insurer, which is a direct contravention of regulatory requirements aimed at protecting policyholder interests and market stability. Professionals should employ a decision-making process that prioritizes understanding the specific risks being insured, the policyholder's risk tolerance and financial capacity, and the insurer's risk appetite and capital reserves. This involves robust data analysis, clear communication of policy terms, and adherence to all relevant regulatory guidelines concerning product design, disclosure, and risk management. The process should be iterative, allowing for adjustments based on evolving market conditions and regulatory updates. Question 18. The audit findings indicate that the weather station data used to define the parametric trigger for a portfolio of agricultural insurance policies is sourced from a single provider. While the provider is reputable and the data appears to be readily available, the audit has raised concerns about the station's proximity to the insured farms and the specific meteorological variables being recorded. What is the most appropriate approach for the auditor to recommend to ensure compliance with regulatory expectations for robust parametric insurance operations? Option A. Recommend that the insurer investigate more cost-effective data providers to reduce operational expenses, as the current provider's fees are a significant concern. Option B. Recommend that the insurer continue using the current data source as it is provided by a reputable meteorological body, assuming the data is generally accurate for regional weather patterns. Option C. Recommend that the insurer rely on the available data, but advise policyholders to be aware that the data may not perfectly reflect local conditions due to the station's distance. Option D. Recommend a comprehensive review of the weather station's calibration records, data validation methodologies, and its geographical relevance to the insured agricultural areas, comparing it against established meteorological standards, and considering alternative data sources if necessary. The correct answer is D. Recommend a comprehensive review of the weather station's calibration records, data validation methodologies, and its geographical relevance to the insured agricultural areas, comparing it against established meteorological standards, and considering alternative data sources if necessary. Explanation: scenario analysis. This scenario presents a professional challenge because it requires an auditor to assess the reliability and suitability of weather station data, a critical input for parametric insurance triggers. The challenge lies in moving beyond a superficial check of data availability to a deeper evaluation of data integrity, accuracy, and representativeness, all within the context of regulatory expectations for robust risk management and fair customer treatment. The auditor must consider how deviations in data quality could impact the accurate and timely settlement of claims, potentially leading to financial losses for the insurer or unfair outcomes for policyholders. Careful judgment is required to determine if the existing data sources meet the necessary standards for operationalizing parametric insurance products. Correct approach analysis. The correct approach involves a comprehensive review of the weather station data's provenance, methodology, and validation processes. This includes verifying the station's calibration records, assessing the consistency of measurements against established meteorological standards, and evaluating the station's geographical relevance to the insured risk. Regulatory frameworks, such as those governing insurance solvency and consumer protection, implicitly require insurers to use reliable data for pricing, underwriting, and claims. A thorough assessment ensures that the data underpinning the parametric trigger is robust, thereby upholding the insurer's duty of care, ensuring fair claims handling, and maintaining the financial integrity of the insurance product. This aligns with principles of good governance and risk management expected by regulators. Incorrect approach is analysis. Accepting data solely based on its availability from a recognized meteorological body without further scrutiny fails to address potential inaccuracies or biases inherent in any data collection system. This approach risks regulatory noncompliance if the data proves unreliable, leading to incorrect trigger events and subsequent disputes or regulatory action for misrepresentation or inadequate risk management. Relying on data from a station that is geographically distant from the insured location, even if it appears to be of high quality, is an ethical and regulatory failure. Parametric insurance relies on precise correlation between the trigger event and the insured loss. If the data source is not representative of the actual weather conditions at the insured site, it undermines the fundamental principle of the insurance contract, potentially leading to claims being paid or denied incorrectly. This could be viewed as a failure to adequately assess and manage the underlying risk, which is a core regulatory expectation. Focusing only on the cost-effectiveness of the data source without a commensurate evaluation of its accuracy and reliability is also a significant regulatory and ethical lapse. While cost is a business consideration, it cannot supersede the requirement for data that accurately reflects the trigger conditions. Prioritizing cost over data integrity could lead to a product that is not fit for purpose, exposing both the insurer and the policyholder to undue risk and potentially violating regulations that mandate fair and accurate product design and operation. Professional reasoning. Professionals should adopt a risk-based approach to data validation. This involves understanding the critical nature of the data to the parametric trigger and the potential consequences of data failure. The process should include 1. Data source identification and due diligence. Understand where the data comes from, who collects it, and their methodologies. 2. Data quality assessment. Evaluate accuracy, completeness, consistency, and timeliness. This may involve comparing data from multiple sources or conducting independent checks. 3. Geographical relevance. Ensure the data source accurately reflects the conditions at the insured location. 4. Regulatory alignment. Consider how the data quality and validation processes align with relevant insurance regulations concerning solvency, consumer protection, and fair claims handling. 5. Documentation. Maintain thorough records of the data validation process and any decisions made regarding data suitability. Question 19. The risk matrix shows a client in the manufacturing sector has significant exposure to volatility in the price of a key raw material and rising energy costs. The client is seeking a parametric insurance solution to mitigate these risks. Which of the following approaches best aligns with regulatory expectations for suitability and client protection when considering non-traditional parametric triggers? Option A. Offering a parametric policy that triggers a payout based on a specific percentage increase in the client's reported monthly energy consumption, without verifying the accuracy or accessibility of their real-time consumption data. Option B. Suggesting a parametric policy that triggers a payout based on a general increase in the Consumer Price Index, CPI, assuming this reflects broader economic pressures affecting the client. Option C. Recommending a parametric policy that triggers a payout based on a significant drop in the client's overall company stock price, as this is a broad indicator of financial distress. Option D. Proposing a parametric policy that triggers a payout based on a predefined threshold for the average price of the key raw material over a 30-day period, coupled with a separate trigger linked to a national average industrial energy price index. Correct answer is D. Proposing a parametric policy that triggers a payout based on a predefined threshold for the average price of the key raw material over a 30-day period, coupled with a separate trigger linked to a national average industrial energy price index. Explanation. This scenario is professionally challenging because it requires an insurance professional to navigate the complexities of parametric insurance triggers beyond traditional weather events, specifically focusing on commodity prices, energy consumption, and economic indicators. The challenge lies in accurately assessing the suitability and potential pitfalls of such triggers for a client, ensuring compliance with regulatory expectations regarding product suitability and disclosure, and managing client expectations regarding the performance of these non-traditional triggers. Careful judgment is required to balance innovation with regulatory adherence and client protection. The correct approach involves a thorough understanding of the client's business operations, their specific risk exposures related to commodity prices, energy consumption, or economic indicators, and how these exposures can be effectively hedged through a parametric policy. This includes evaluating the availability and reliability of data sources for the chosen trigger, the correlation between the trigger event and the client's financial loss, and the potential for basis risk, the risk that the trigger event does not perfectly align with the actual loss. Regulatory justification stems from the principles of treating customers fairly and ensuring that products sold are suitable for the client's needs and risk appetite. This requires a proactive and diligent approach to client assessment and product design, aligning with the spirit and letter of regulations governing insurance product sales and advice. An incorrect approach would be to recommend a parametric policy based on commodity prices, without a clear understanding of how fluctuations in those prices directly impact the client's profitability or operational costs. This could lead to a policy that does not adequately cover the client's actual financial losses, potentially violating suitability requirements and failing to treat the customer fairly. Similarly, proposing an energy consumption trigger without verifying the accuracy and accessibility of real-time energy consumption data, or without assessing the client's ability to accurately report this data, would be a failure. This could result in disputes over claim payouts and a breach of disclosure obligations regarding the limitations and data dependencies of the policy. Recommending a policy based on broad economic indicators, such as GDP growth or inflation, without a demonstrable and quantifiable link to the client's specific financial losses would also be problematic. This approach risks misrepresenting the policy's effectiveness and could lead to a product that is not fit for purpose, thereby failing to meet regulatory standards for product appropriateness and client protection. Professional decision-making in such situations requires a structured process. First, deeply understand the client's business and their specific risk exposures. Second, research and evaluate potential parametric triggers, focusing on data availability, reliability, and correlation with potential losses. Third, assess the client's capacity to understand and manage the chosen trigger and its associated risks, including basis risk. Fourth, ensure full and transparent disclosure of all policy terms, conditions, limitations, and data dependencies. Finally, document the entire process, including client discussions and risk assessments, to demonstrate due diligence and compliance. Question 20. The assessment process reveals that a UK-based insurance firm is preparing to launch an innovative parametric insurance product designed to pay out automatically based on predefined weather events. The marketing team has drafted promotional materials that highlight the speed and simplicity of the payout mechanism. However, these materials have not yet undergone a formal review by the firm's compliance department to ensure adherence to UK insurance laws and financial promotion regulations. What is the most appropriate next step for the firm to ensure compliance? Option A. Rely on the product development team's technical understanding to ensure the marketing materials accurately reflect the product's functionality, as they are most familiar with its mechanics. Option B. Proceed with the marketing campaign as planned, assuming that the innovative nature of the product means standard financial promotion rules are less stringent. Option C. Distribute the marketing materials to a small, select group of existing clients for initial feedback before a full compliance review. Option D. Immediately submit all drafted marketing materials to the firm's compliance department for a thorough review against the FCA's Conduct of Business Sourcebook, COBS, and relevant SISI guidelines before any dissemination. The correct answer is D. Immediately submit all drafted marketing materials to the firm's compliance department for a thorough review against the FCA's Conduct of Business Sourcebook, COBS, and relevant SISI guidelines before any dissemination. Explanation. This scenario is professionally challenging because it requires navigating the intersection of product development, marketing, and regulatory compliance within the specific framework of UK insurance law and SISI guidelines. The core challenge lies in ensuring that the communication of a new parametric insurance product is both accurate and compliant, avoiding any misrepresentation or misleading statements that could harm consumers or breach regulatory expectations. Careful judgment is required to balance the need to effectively market the product with the absolute necessity of adhering to all applicable laws and guidelines. The correct approach involves a thorough review of all marketing materials by the compliance department, specifically checking for adherence to the Financial Conduct Authority's FCA Conduct of Business Sourcebook, COBS, and any relevant SISI professional guidance. This ensures that all claims made about the product's triggers, payouts, and limitations are clear, fair, and not misleading, as mandated by FCA principles for business and COBS rules on financial promotions. This proactive compliance check is essential for preventing regulatory breaches and protecting consumers. An incorrect approach would be to proceed with the marketing campaign without a formal compliance review. This fails to meet the regulatory requirement for ensuring that financial promotions are fair, clear, and not misleading, as stipulated by the FCA. It also disregards the professional responsibility of SISI members to act with integrity and due skill, care, and diligence. Another incorrect approach would be to rely solely on the product development team's understanding of the product's mechanics for marketing. While the development team understands the technical aspects, they may not be fully versed in the nuances of regulatory communication standards for financial products. This oversight can lead to marketing materials that, while technically accurate, are not presented in a way that is comprehensible or compliant with FCA requirements for consumer communication. A further incorrect approach would be to assume that because the product is innovative, it is exempt from standard marketing regulations. Parametric insurance, like any other financial product offered in the UK, is subject to the same regulatory scrutiny regarding its promotion. Innovation does not grant immunity from compliance obligations. The professional decision-making process for similar situations should involve a clear workflow. 1. Initiate marketing material development with a strong understanding of regulatory requirements from the outset. 2. Ensure all marketing content is reviewed by the designated compliance function. 3. Verify that the review process specifically checks for compliance with relevant sections of the FCA handbook, particularly COBS, and any applicable SISI professional standards. 4. If any ambiguity or potential for misinterpretation exists, revise the material until it is demonstrably fair, clear, and not misleading. 5. Maintain comprehensive records of the review and approval process for audit and compliance purposes.